And thank you to everyone for joining us. I know there is a webinar overdose, and I think nothing but the fact that I got Nithin and Harshil together to speak could have got so many people out on a Friday afternoon. Thank you for joining us, and hopefully we'll make this an engaging and open conversation. I think one of the things, at least for me, that makes both Nithin and Harshil stand out and their company stand out is that they've just built products that consumers and customers love, and therefore they've been able to tide through any fluctuations that always happen in the fintech markets. And maybe start a little bit with, when did you first think about, hey, this COVID situation is going to really impact the overall economy, the fintech space, and my business? And what were some of the early actions that you took, and then how has that sort of unfolded for you? Maybe just talk people through that thought process in your heads and for the company as much as possible. And then, we can dig into a little bit to how you see the future panning out. And maybe Nithin, start with you on that one.
Right. Sorry. I got a lag. Yeah. So we are in the center of the action, right? So even before the news got out, the stock markets had already started reacting. The stock markets kind of under the curve all the time. It's trying to factor the worst news. So the realization was there. I think, so we had like a big incident on March 9th. When crude oil fell 30%, so and because how it works for stockbroking businesses, if something moves too much, then it's a problem. As long as stocks, commodities are moving in a certain range, it's quite okay. But as soon as the range is more, is when it's a disaster. But even like a mini disaster for March 9th, I think it was kind of, the writing was on the wall saying it's going to get worse. So it's kind of constantly gotten worse. Thankfully for us, the last couple of months have been probably the best 2 months in the last 1 year or so. Actually, right from the start of the business, we added more customers in the last 2 months than we have ever added. We have seen more transactions per day in the last 2 months than we have ever seen. So our problem has been more in terms of managing the scale than the economic disruption of the virus that other industries are seeing. Just to give you an example, we're doing on average around 7 to 8 million trades a day. We would do 3.5 million trades before average 3.5 to 4 million. So today we have been struggling for the last 1 month, 2 months to increase scale. And added to that, the volatility, of markets, the risk management issues, to work from home, all put together has been quite. Then we can't really complain, considering that at least we have things going for us in the last 2 months. So yeah, so that way it's been quite okay.
Got it. Harshil? Harshil, are you there? I think we might have lost Harshil for a second. I'm going to request Anubhav or Saloni, if they're on the call, to try and get Harshil back. Nithin, just moving forward with just, in a sense, you're sort of in the middle of the action where you're getting sort of signals from across the industry and across sort of the fintech industry on two things. One is how consumers are reacting, and also how you see different startups actually are able to either take advantage or have to take corrective action in the situation. One, from a consumer perspective, how are you looking at what are sort of, what are changes in line that you're seeing with what you expected, and what are changes that you're seeing with the consumers this time around, which you didn't expect? Like one of them you said is consumers actually increasing the number of accounts and actually wanting to invest. And maybe start with that, and then we'll talk about the companies and what actions they're taking.
Right. Yeah. No, I mean, I think, see, the thing is, I've been doing this for like, I don't know, 15 years now. I used to be a sub broker before Zerodha. So And I've never seen in these 15 years people wanting to open new accounts. Markets are not doing well, right? And that way, this last 2 months have been quite crazy. Actually heading into the event, we had AI Cards IPO. There was already quite a bit of interest uh, from customers to open new demat accounts. But then after the IPO and the market started coming down, the interest actually picked up. So which is very surprising. I mean, what is in line is the wallet, because of the volatility, there are more trades and all of that. That's kind of in line. But what was little off was this whole, people wanting to open new accounts, people wanting to invest. I mean, it's the same, like I've been speaking to, friends who run uh, uh, investment tech startups. I've been speaking to brokers from around the world. The behavior is the same. Even in the US, most brokers have seen max accounts that they've opened in the last many years, in the last 2 months. So yeah, so it's I think the weird thing in this last few months has been this whole interest to kind of open accounts, invest in the markets. I guess also it's got to do with people working from home. So I think a lot of people had it on the checklist to have a demat account, trading account, investments in the market. I'm guessing so. Finally, people have the bandwidth sitting at home to go ahead and open one account.
All right. Nithin, I'll give you a break and ask Harshil that question. Nithin, when you're speaking, I think there's a little bit of static coming from your end, and maybe I don't know if you just need to move closer to the mic, or
Okay,
you might need to grab your AirPods.
right. Sure.
So, Harshil, welcome back. So, the question that I was asking Nithin was, when did you get a first sense from all the signals across the ecosystem, given that you're plugged in everywhere, that COVID is going to be a much bigger deal and much longer period? And how did you start taking actions? And just talk us through the chronology in your head and where you are right now, and then we can talk a little bit about the future.
Yeah, thanks for that. I think initially we got the first hint somewhere around early. I mean, we were of course hearing news from China early Feb, late Feb, but somewhere around early March and late Feb, we started getting a feeling that this could be broader. This is the time when cases in India started scaling up as well, and we started getting a feeling that this could be broader than what it seems like and the way people are taking it so far. The way the China ecosystem was reacting, we were constantly getting news on how the ecosystem was behaving and how it seemed that recovery was far away. And frankly, just sitting in a room and thinking about it, we couldn't see a way how it could be resolved quickly, because there was no cure for it. It was pretty certain that a lockdown or something like that would happen sooner or later. And because we power payments for so many businesses, we started noticing that businesses have started reacting to it in various different ways. I mean, of course, stock brokerage is one thing, and then we have some mutual fund platforms, some direct equity platforms on which you're starting to see different kind of activity. For us, it was a double whammy as well, because somewhere in early March, we also saw the Yes Bank issue which came up, and that had a major impact. So Yes Bank issue came up and the COVID situation, both of which came very close to each other. And our teams were working full time, first to resolve the Yes Bank situation, and second to plan out how would we come out of this situation, because at least by first, second week of March, it was clear that this is going to be an extended journey. I think as a company, we started work from home and remote working a little earlier than most. That I think we took a little safer approach. Also, because we are mostly a tech product company, it was easier for us to move to a work from home setting. So we moved to work from home earlier as well, so that we could iron out all the gaps and everything. And when the lockdown came into effect, we were a little better prepared to handle that situation. If you ask me right now, I think right now, at least the way it looks like, it is at least a 6 months to 12 months phenomena, if not more, from a point of view of economic recovery. And even right now, we don't have a view on what will be the bottom of this. So I think we are all in cash conservation mode. The idea is that to reduce spends to minimum to ensure that we can survive through this issue. And yeah, at the same time, we are trying to find opportunities that we can make use of in this time. So there are certain segments, certain opportunities that are coming up where certain segments which are seeing very good growth. So for example, we have doubled down on gaming, financial services, edtech, and those segments where we are seeing rapid growth during these times. So I think that's where we are right now.
That's good. I'll just give my own perspective, and we have a very wide fintech portfolio across, and obviously fintech, and especially on the lending side and so on, is the most affected, because if borrowers are no longer spending, they're not no longer able to repay, and banks can't really lend. As the fintech ecosystem, we're sort of stuck in the middle between all of these sides, and suddenly your cash flows just take a huge hit, because you're usually moving a lot of cash between banks and borrowers at any point in time overall as an ecosystem. I think one of the first things that we did was to tell everybody to go into a scenario planning for a very deep U-shaped recovery mode. And one of the things that we said is that overreaction is the only reaction for every fintech. I think across the board, everyone came to that view very quickly over a 7-day period, and took a lot of corrective action to make sure that we are managing the overall risk in each company. And I would say when I look at the fintech ecosystem today, people have done a very good job in terms of just managing the overall risk, working with partners, borrowers, consumers, and customers at your end to make sure that at least that risk is somewhat contained. Question for both of you guys: when you look at the consumption patterns and the way consumers are behaving towards both fintech products as well as non-fintech products, what are some of the changes that you're seeing which are sort of permanent, and what does that mean for sort of the long-term growth of fintech in India?
Yeah, I mean, see, the thing is, what we are seeing at Zerodha right now is a change in the investment behavior. Right? I mean, okay, this my static. Right. So the change in the investment behavior is what we're seeing right now. So we are seeing people kind of try to buy into stocks which are beaten down. So stocks which have lost more, which I don't know if it's the right strategy, because the idea is to be in stocks which are doing well, and because they are the ones who will probably have the the U-shaped recovery that you're looking, will probably benefit the most. I think there are some dark clouds around, I mean, if you've seen what has happened with Franklin Templeton, etc. So I think a lot of people who are in debt mutual funds, thinking that it is like a fix, it's almost like an alternative fixed deposit. I think right now questioning that whole thesis on which they're invested. So I think, one thing is for sure, I mean, I'm talking about investment tech. I think the interest rates that you get from the banks are going to be muted. I don't think, we're going to go back to that 7% plus kind of things, right? So it's probably going to be in this 6 and lesser than 6%. So I think people will look at alternate ways to make a little more money than what is, what can be done through their bank, their fixed deposits. So we right now what we're trying to figure is what is that, that safe way between bank fixed deposit and taking risk with direct stocks. So if there is some kind of like a layer in between, which can where we can push customers to kind of be in diversified portfolios of debt plus gold plus something that we're okay.
Harshil?
Yeah, I think the way we operate, we see consumption across various sectors, and we are seeing like certain sectors which are moving up, certain sectors which are moving down. And I think some of those shifts will be permanent in nature. To give you an example, billing and utility is a big part of our portfolio, but overall the amount of utility bills paid online versus offline is hardly 5 to 10% of the market. Most utility bills, at least in tier 2, tier 3 cities, are still paid in standing in queues in ration shops and kirana shops and other places. So right now we have seen about a 70% increase in the utility bill payments through online channels. Because people are trying to figure out how can you do that online, and I think some of those behavioral changes will be consistent in long term. It's like the shift from booking a train ticket in the railway station versus booking an RCTC. Once people move to that behavior pattern, it's difficult to move back. So this is what we are seeing in billing as a segment. We're seeing in grocery, online grocery is scaling up massively. E-pharmacy as a segment is scaling massively. EdTech as a segment is scaling massively. So these are certain changes. And yeah, not the entire surge might not stick once things go back to normal, but there'll be a good percentage of this surge that will continue to stick and say that, yeah, this seems like a better way of operating. And that is what we are betting on as an opportunity. the newest digital platforms which allow you to, let's say, buy mutual fund, buy securities. Zerodha is one of them. Through a completely digital channel, are seeing a lot of growth rate versus the traditional model where people go through relationship managers who help them allocate funds. And I think again, some of those behaviors might stick as well in the long term. So overall, there'll be some positive impact of this, especially in the transition towards from old economy to new economy. And I think this will be kind of an accelerant towards that journey. How much of that stick we'll still have to watch out for.
So as an investor, I end up making larger leaps of faith. So I would say that I do think that this COVID period is going to be as significant as demonetization was, or the Geo launch before that. And we saw these step jumps in both number of users coming as well as the usage. And I think this is going to be one of those. And I'll give you two examples. One is teachers. Teachers were very hesitant to actually adopt technology in mass. They've been forced to, because every school has become an online school. The second is doctors. Again, very hesitant to adopt technology, and they've had to adopt technology en masse on telemedicine and so on, because that's the only way they can keep in touch with their patients. I think we can take examples like that across the board, where I think there is both increase in the number of customers, as well as the number of as well as the usage that they're doing, and as well as the money that they're spending online. What that means for fintechs is that you have an overall larger pool of spend to play with. It also means there is a very different set of contexts that you end up having to consider, which means that you will have more micro serving products, more micro lending products, and more different GTMs and go-to-market strategies, where you can now find an edtech consumer consuming something very differently, or or a consumer wanting to do very different savings for a particular consumption online, and therefore you'll be able to acquire different users from different GTMs. Guys, just before I actually I'm at the end of my last set of questions, two requests. One, to the audience, to make sure that there are a bunch of questions in the Q&A. Can you guys just upvote on the questions so that we know which ones to tackle? And that's our prerogative, which we tackle, which we don't. But please upvote. Second, to Anubhav, could you also paste all the different questions that have come from the registrations so that they can also upvote those? I'm going to pick on some of those questions anyway. Guys, last set of this, and this is really sort of the, are you short or long, and in what well, we're all long, given that we're all associated with fintech. I think it would be good to figure out why you're long in the long term. But in the short term, what are the biggest risks that you see, and what advice do you have for a lot of the fintech founders who are on the webinar?
Yeah. So yeah, like you said, right? You're kind of forced to be long. I don't think there is any option apart from that. So the thing is, I think the stock market is saying that there's a recession, right? So I think at best case, this is at least a 12 to 15 month kind of a like bad phase. I hope it gets done in 12 to 15 months. I think what we need to kind of, I think all fintech founders need to do is figure ways to have that runway covered for, at least for the next 2 years. So what we're trying to do as a business is all these inefficiencies that existed in the business, I mean, even the smallest one, which got ignored, otherwise when everything was hunky-dory, right? Kind of going after that and fixing those issues. Some of those issues that are that small little issues, even the slightest, we're trying to save, wherever possible. So wherever there was extra money being spent, we're trying to conserve on that. So I think yeah. So next 12 to 16 months is, I think, bad. But like you said earlier, right? I think by the end of it, the recovery is going to be quite fast as well. Because one of the things that we've seen, even in the last 2 months of this whole fall, is that there's a lot of money by the side. That people are sitting on, there's a lot of wealth which is sitting in people's bank FDs and savings bank and etc. So it's not that there is no money and people will not stop. I mean, right now I think people are panicking, so it'll take some time for them to get back to spending that money. But when they do, I think newer opportunities are gonna open up. So, so what are the kind of opportunities that will open up the end of it? It's tough to say, but um, like personally for me, running Zerodha, I think we need a better fixed income product for the customers. Right? So for someone who's looking at making more than the bank returns and maybe not take as much risk as being in direct stocks. Uh, so so I mean that's how I'm looking at this.
Yeah, I think very similar view from our perspective. I think there are two things. One is this incident affects almost everyone, large companies, small companies. I think nobody had predicted or planned for something like this coming up in 2020 out of the blue, and most companies are very severely negatively impacted. I think that, and that's where I think that fintech companies in particular and startups in particular, I believe, would be faster to respond and be able to adapt to this crisis as the situation evolves, simply because they're smaller, nimbler, and one of the biggest strengths that startups have against large players is the nimbleness and the agility with which they move. So I think, yeah, some startups might struggle and might struggle to stay afloat or raise funding in these times. But overall, I believe fintech companies and fintech startups, which are operated well, which have always stayed focused and stayed true to their fundamentals, will be able to wade through this crisis and at the same time adopt to the crisis to find opportunities in these times so that they can stay afloat. And that's the primary reason I would stay long on the ecosystem, because I believe there are a lot of good companies who will be able to manage through the crisis and be able to find opportunities of growth in these times.
Yeah, I'm going to just touch upon two things, Harshil, that you said. One is, from a consumer standpoint, every consumer and customer has been affected, and therefore, and in their relationship with money has changed, right? Either and by and large, everybody is more worried about money, right? Whether you had savings, whether you had investments, whether you're a businessman, whether you're a migrant worker, everybody's relationship with money has changed overnight. And one of the ways in which they've been able to get quick access to money and at least keep track of money and where they are is digital. And I think digital platforms which sort of really dig deep on how that relationship with money has changed and touch upon sort of products which actually go after, let's say somebody wants to do a savings product, and Nithin, you're clearly thinking more on the fixed income product, because people will be thinking more on how do I actually do capital preservation in a short period of time. And people who are thinking along some of these, how relationship with money has changed and design products will actually benefit. I think the second thing is overall risk in the ecosystem has permanently changed. So if you look at risk models that were true in March, they're no longer true, because the overall money in everybody's hands has just changed. And therefore, the lending risk in the ecosystem has changed, and therefore everybody has to throw out their old risk models and come back to existing risk models. The second thing that Harshil said in terms of just the overall fintech ecosystem, I do think that the fintech ecosystem and each fintech company has to be able to manage shocks. And if you're not able to manage shocks, you actually don't belong in the financial services ecosystem, because if you take the history of financial services globally as well as in India, you'll just keep getting these shocks. I think this is one shock, and sort of like demonetization, where the companies that emerge stronger will actually become very large very quickly. And we have seen that coming out of demonetization. One quick question for you, and both of you are sort of reasonably large and so on. When you think of large companies versus small companies, do you worry that only the large companies will emerge stronger and the smaller companies won't?
Not really, like when I look at our competition, I think I fear the smaller ones more than the larger ones, actually, because I think larger ones will actually have. I mean, of course, they probably will have more runway to get through this, but then they also have a lot of legacy issues, that will pop them down. I think what the current scenario is giving is, I think you need to innovate right now to survive this. Just having money in the bank is not enough, right? I think you need to be, nimble and come up with new products, because what worked before COVID, I don't think is going to work. Uh, like the behavior.
That's a great point.
Right. So I think, yeah, I think smaller, nimbler is actually a lot more better than larger and bigger.
No, I completely agree with Nitin's point here. I think one thing I keep saying to my team as well is that the large guys, while of course we compete with a lot of large guys as well, but the competition with large guys is predictable. You know what they're doing, you can adapt to it, you can take care of it over time. It's the small team sitting in a garage or sitting in a house who are building something which might be completely unpredictable, which is and I think and those teams can be extremely nimble, extremely hungry for growth, and I think that's the way we emerged as an organization. I think that's the way Zerodha emerged, and there's no reason with or without this situation, such companies will not be able to emerge. In fact, when money is low, we see more of such people doing more of such experiments, being able to find more of such hacks that can lead to rapid growth without utilizing so much money. So I think the world is pretty fair in the sense that right now this crisis affects big and small almost in an equivalent way. In fact, bigger the companies, they are affected much worse because it's harder for them to move, harder for them to shift focus. And at the smaller the company or more nimble the organization is, it's easier for them to shift gears and say, hey, how can we make best use of this opportunity? So I think that will be my take on it.
Sounds good. There are two questions that seem to be emerging as a theme. I'm going to touch on the neobanking question first. And this is one of the questions that I think all three of us get asked very frequently on what is a neobank and is that the next big wave in India? And do you really think consumers will trust complete digital-only new brands? And Harshil, maybe start with you first, given that you have launched Razorpay X, and maybe you can give a brief on Razorpay X and how you thought about it. And do you really see a wave of sort of new digital brands that could take over, especially in this post-COVID world? And I'll come to you, Nithin.
I think pre-COVID, we were seeing customers' relationship with banks change significantly. I think the historical view of bank, where people view banks as a large building in their city or in the small town where they could park cash safely, which would have a large locker room, which would ensure that your cash is safe from dacoits and thieves, is not the view where today's consumers carries about banks. Like banks is not the way to just park your money safely. It's a way through which you can move your money around efficiently. You can pay out to your people, you can collect payments, you can park your money into instruments. I think that's the current view of banking. I think post-COVID, that situation, that transition will happen even more rapidly because even consumers who prefer to go to a bank branch and transact through that are forced to do it digitally right now. And they'll discover that they don't really need to go to a bank branch. Everything can be done by a mobile app, can be done by a dashboard. And if somebody is able to build a new banking experience which can provide a better dashboard, a better mobile app, a better way of moving that money around, a better way of managing it, and also can provide a lot of custom-built financial products on top of it, I think people will I think it's now an apple-to-apple comparison versus between a bank and a new bank because both of them are digital right now. Versus a pre-COVID world where one of those was present right across the street, while other one was only digital. Right now, everyone is digital. So I think that transition will happen even faster right now because people will be forced to trust digital platforms more. And as they trust digital platforms, they'll compare digital platforms versus digital platforms. And in that thing, I think some neobanks who are building very strong digital products will emerge out as winners.
Yeah, that's a great point. And do you also worry that banks will, reconfigure their sales team such that they are all serving their customers digitally overnight?
No, I agree. I think banks, no matter how much we talk about banks, I think they have been one of the most stable and like they have, and especially some of the top banks in the country have been very agile in their sales, in their marketing, in the way their products are structured. And I'm pretty sure they'll respond to this scenario as well in a pretty good way. I think the best products that will come out will be where a fintech and a bank work in a very close collaboration because there are certain things that banks are really good at, whether it's managing compliances, whether it's managing risk, managing treasury. But there are certain things that fintechs are exceptionally good at, which is building products, building tech, building solutions. I think the products where both of these come together and create a win-win scenario for the customer will emerge winners. I think our idea with Razorpay is very similar. We are not saying we're completely working against banks. In fact, we are partnered with 2 banks, which we use as the backbone, and we have built our product and tech on top of it. So the backbone and the safety and security of our money is guaranteed by the bank, while the tech and stability of the tech, stability of the platform, and all those things is guaranteed by us, which is a fintech. And I think those kind of win-win combinations will emerge a lot more.
Well said. Zerodha, I'm sure you've thought of neobank. What is a neobank?
Right.
What are your thoughts?
No, I mean, if you actually think about it, right, we are a neobank, in a way, right? Because people keep their money with us. they buy stocks with us. They keep their securities with us. Of course, you can't use that money to buy, like a normal bank, right? So, no, we've been watching this closely. I mean, we're trying to say that, okay, if we are already doing all of this, can we extend this into also being like a neobank that others are? It's just that it's kind of outside our core competency.
Yeah.
It's not something that, it's not something that the core team enjoys doing in any case. So we probably will end up partnering in the bank. And also, like, I think an important angle to this neobank, right, is a credibility angle. So it took us 10 years to kind of get to a point where people trust us. And even today, people, like we struggle to convert the 40-year plus to being a customer, right? Because for a person who has more money with him, the credibility of the brand matters. So we lose out these customers to the bank brokers because more people trust, the ICICI, HDFCs of the world a lot more than they would trust someone like us, right? So I think where the neobanks will have a problem is that, you can get a lot of this 1,000, 5,000, 10,000, 20,000 customers, but the money is not there, right? The money in India is lying, in the 40 plus crowd. And as a bank, the basic logic is that you make money on the money that's lying with you, right? And then,
Yeah.
if you don't really have money lying with you, how do you make money is a question then, So, uh, um, so will the older gen, who have a lot of money on them, start using neobanks? I'm still not sure about it.
Yeah. So I won't evade the question, given that we've invested in quite a few, and I'll give you a quick snapshot of our thesis. I think we are looking at neobanks as two types of neobanks. One is sort of bank account first neobanks, which are taking existing bank accounts and putting a digital product and app around those bank accounts. So people like Jupiter, Yellow, and so on are neobanks there. I think the other kind of neobanks that we are looking at are what we call store of value neobanks, and both of you are sort of store of value neobanks, right? Because you have a extraordinary store of value, and in Razorpay's case, it defines the merchant's business, so it's a big store of value for them. And in your case, it's a big store of value in terms of savings. As those stores of value get bigger, you can actually put banking like services around it to actually become a neobank. So there are two types of neobanks that are possible, and at some point of time, both of these will merge in some ways, is our overall view. The one thing that at least we think is that if you can take that store of value and capture all financial flows, not just one section of financial flows, so which means their income flow, their savings flow, their expenses flow, and big life events which require credit. If you're able to capture all of those, then I think you can build a profitable enough model around it. And that's where Nithin, I differ a little bit, where even for the low income consumers, I think if you capture all of their flows in one account, then it actually can lead to a profitable model. Why was it not possible before? Because you just couldn't reach them at a low enough cost. At least that's the theory. We'll find out in a couple of years whether that theory works or not. I think the other question, I'm just moving on to the next set of questions, is what is day 2 of the Facebook Reliance partnership? What does that mean for the overall ecosystem? I'm sure all of us have been talking about it. I don't think any of us can absorb exactly what it means, but sort of early thoughts on it.
Yeah, I don't really make too much sense of it either. So I'm trying to figure out what does it really mean? Is it good or bad? Because you suddenly have this monopoly of sorts. So is it good for the ecosystem or not? Is something that I'm still questioning. But I think if like Mr. Ambani said, he's gonna digitize these 3 million kirana stores. Oh, sorry, 30 million kirana stores. I think it's good for the for the country. I think it's required. So no, I don't really have a point of view on that.
Yeah. Harshil, add on to that question, because obviously there's a WhatsApp Pay angle to it as well. So I'll ask you to comment on that as well.
Yeah, so I think at least on paper it looks good for the ecosystem, because, for example, something like WhatsApp Pay, we have been batting that WhatsApp Pay should be made available in the country, because the kind of adoption it can bring to digital payments is unmatched. And I think hopefully this can allow faster rollout of WhatsApp Pay, which can make transition towards digital payments even faster. Like, and it's one of the only apps which has that high number of DAU, like 250, 300 million DAU, the kind of retention it has, the kind of growth it can lead to digital payments is astronomical. And in general, like more the competition, more players, it's better for the ecosystem, better for players like us, because we essentially play on the fact that there are too many consumer instruments. So we can simplify that for businesses. The only challenge would be that on the execution side, if it ends up creating a situation where it monopolizes the market and it discourages new players from entering, or it makes harder for new players to enter, then of course it cannot be good for the consumer. Less competition is generally bad in markets. So as long as it doesn't take that shape, overall, more the players and more the platforms available in the market, the better it is for the ecosystem.
But do you think that this is too big of a monopoly that is getting created? Do you get that sense from the ecosystem?
So I'll talk about from a payments perspective. From a payments perspective, at least RBI's and NPCI's view is very clear. No matter how big you are, they want to constantly ensure that nobody is able to monopolize the market. We have seen how in the PPI world, they constantly keep changing regulations. In UPI world, they constantly kept changing regulations. And unless there is some undue pressure on RBI, I think their view will not change. From our conversations with RBI and NPCI, it's very clear that they would not let anyone monopolize the payments market, which I'm placing my faith on RBI, because even in times when a lot of things are happening in the broader ecosystem, RBI has continued to maintain that stance and been able to deliver on it. And I would place my faith on them to be able to execute on that.
Yeah. So I'm just going to add my 2 cents. One, two of the largest companies in the world coming together is obviously a big deal. And does that create some level of fear and risk for individual businesses? Absolutely it does. And I think it's up to you to actually figure out what is that individual risk that comes into your businesses. I'm going to echo what Harshil said, which is I do think that the overall RBI and NPCI have worked very hard to create an equal playing field. I don't think that they're going to let it go back to a monopolistic ecosystem at all. So I would place my trust there as well. At an overall level, I do think this is one of those events which is going to lead to an even larger explosion of data and transactions. And that overall larger explosion of data and transactions can only be good for the fintech ecosystem, because it just helps you create more and more different products. And also with the explosion of data, you should hopefully be able to underwrite risk more real time than you are able to do today. So both of those 2 things should help the overall fintech ecosystem more. I'm just going to go through some of this. I don't know if either of we touched upon this in the neobanking scheme of things, which is API-based banking, and which segment of API-based banking might develop the fastest. Harshil, maybe specific question for you, if you want to take that quickly.
Sure. I truly believe like API-based banking it was a trend that was emerging pre-COVID as well, and a lot of banks were doing this, a lot of fintechs were trying to do this. Specifically I think for consumers, API-based banking might not make too much sense, at least in initial days. What API-based banking might allow in the consumer space is for platforms to emerge. Platforms like Mint that have emerged in US can come out in India, which can allow consumers to better manage financials and transactions without actually being a bank. I think that can be the impact on the consumer side, but I don't see too much use cases, at least so far in the ecosystem. But on the business side, we are already seeing a lot of use cases for API-based banking. We are seeing businesses who are adopting banking APIs in a big way, because fundamentally what change has happened is that banking is no longer a finance problem. To give an example, we work with companies like Swiggy. Now, in a standard company like Swiggy, when you have to pay out to restaurants, it's considered a financial problem. It's a payables problem. Finance team will take care of it. But in a company like Swiggy, it is actually a product problem, because if the restaurant is not paid out the same day, the next day the restaurant will not come online and it will lead to a poor experience across the product. And that's why paying to the restaurant on time is not just a finance problem, but it's actually a product and tech problem. And that's why these companies like these are trying to adopt API-based banking to ensure that they can use banking like an API and ensure that real-time delivery of services can happen on the banking channel as well. I think those kind of trends will emerge in bigger ways during COVID times, because these companies who were handling these things manually or through cash and check and other means would also try to automate these processes, which makes the use case for API banking even stronger.
Nithin, I'm going to come to you on the wealth management side. I think I'm trying to bundle a few questions together. One sort of near-term impact of what you're seeing happening in the debt markets and the debt mutual fund markets, and how you're seeing both the pros and cons of some of those actions. And second, long term, how do you see wealth management evolve, both at the HNI end as well as sort of the mid market and lower end?
Yeah, no, I mean, I think what happened with Franklin Templeton yesterday is quite shocking. I mean, I think it's not really shocking; it's surprising maybe because people knew that there is no liquidity for a lot of those papers. So, and there were redemption requests coming through. So, so what they did is probably the only thing they could have done. Now, will this be a contagion effect? Will other debt mutual funds do the same? Uh, you know, potentially those higher yielding, higher risk kind of paper, the is sitting on, there could be redemption pressure on that. So yeah, so it's tricky. I mean, I don't want to be, saying that you should go and redeem, uh, but yeah. So on the wealth management side, see, the thing is, I think if you have to look at how US has evolved, right? Uh, it was through the advisory network. I think one of the things that India has missed out is this whole professional advisory ecosystem. And because today what happens is most people who come out of college, school, they see how their parents invested and they end up doing the same, right? If it's not their parents, it's their friends and family. No one is actually, like we have never thought about money in our school, colleges, or at work, right? And I think uh, the way like some of the developed economies work was there was this whole professional advisor ecosystem layer. I think in India, it just got missed. What happened in India was the guys who were advising were also the distributors, in the sense these were people who are earning commissions from manufacturers. Uh, so what happened was it was always a conflicted kind of relationship. So I think the way I think this, I don't like personally, I mean, it's kind of weird coming from someone like me who runs a digital platform, but I think uh, the way this wealth management will work will probably be more physical than digital. I don't think it's very, I mean, a person will allocate, a small portion of his wealth through an app, right? But then as soon as it's significant, he wants to talk to a human, he wants some advice, that behavior hasn't changed, not just in India, even if you go to the US, the guys who are onboarding on, the wealth management apps are more younger customers. As and when the wealth becomes large, they need some human advice element to it. Right? So yeah, so I think not just HNI, today HNIs in India get access to that service. So I think the way forward is for someone like us to build a platform to give a similar kind of service and access to advisors that HNIs get, even if people didn't have too much money on them. And yeah, so that's one of those things I have on my list of things to do. If if we can't solve it on our own, we'll probably partner a startup who's trying to solve this problem and do it together. So.
All right. Excellent. Harshil, any quick thoughts on wealth management? I know a lot of the apps use you as the platform.
Yeah, I think one of the things that we have seen in wealth management during these times, even though it was surprising, and I'm not as much of an expert as Nithin is, but I was surprised that when the stock market was falling, the amount of transaction in most wealth management apps went up significantly. And as a layman in the stock market space, it was really surprising to me to see that people were parking more funds in SIPs, more funds in mutual funds, and I continue to see that trend. Some of the pure digital direct mutual fund apps that are powered by Razorpay, we have seen growth as high as 50, 60, 70% compared to baseline volumes during these times, which means that generally people because generally mutual funds people park for long term. People still have a positive view of in the long term of the wealth management space. In general, the market, while short term there is shock and equity markets are falling, people have a view that in 2 or 3 years time frame, these things will recover and the market will emerge out positive from here. I think that view was a good learning for me personally to see that okay, markets still have a positive long term view right now.
Yeah, I think I have a take on this, right? So the thing is, the people who are investing in the markets, right? I don't think they're seeing the economic impact of this virus yet, right? I mean, we're all sitting in our houses, and and we don't really know what's really happening to the economy, and we suddenly see all these stocks available at 50, 60% discount, and you're like, dude, why is the discount available, right? Because you haven't seen the damage. So like we've been trying to slow some of the people down. I mean, people who are extremely bullish because it. I don't know if this is a time to be just because the market's down, it's a time to go and put all your savings into it. I mean, it's a good time to get started if you haven't. Maybe allocate portions of your wealth, because stock markets, the rule about stock market is, trends kind of last, right? And we are currently in a downtrend, and like I was telling earlier, I don't see how this trend is going to get over in the next 12 to 15 months. I think.
Yeah, I'm just gonna add. I think there is this saying in investing, don't catch a falling knife, and I think the knife still hasn't fallen. And I think I would say everyone should be more cautious than they are being. On that falling knife comment, how do you guys think that the private markets, especially the venture growth investing market, as well as sort of the fintech investing market, is going to evolve in the near term as well as the long term?
No, I think you should answer that question.
I will, but I am going to. But given that both of you are both early stage investors as well as every investor talks to you, I'd love to.
Right. No, the thing is, surprisingly, I mean, the thing is, I interact with only typically startups working in the investment tech, people building products around savings and investing. And that crowd, maybe it's because the business isn't really down. That crowd is still not negative as such. I mean, everyone's positive, and so I don't know about the overall ecosystem, because my focus has always been just this world around, and that place seems quite okay. As in, people are doing okay, and outside that, you're probably in a better spot.
Yeah, I think as Nithin said, Vikram, probably you are the best person to answer this, but I'll add my thought. I think based on my conversations with investors and like startups in the ecosystem, I do believe the market will change a lot. I think investors will be a lot more selective than they were in bull times. Uh, Capital efficient companies or companies which have strong fundamentals will still be able to find money. But yeah, conversations around gross margin, gross revenue, those will be stronger than vanity metrics like TPV, GMV, and things like that. Uh, and generally investors will be more selective, primarily because multiple things, like generally because public markets are down. If anyone is investing, they might prefer to invest in public markets than in private. We had one of the largest bull runs in the private markets, at least in the US private markets, for a long time. And I think some of that correction was needed as well. So some of the pre-COVID situation where anyone and everyone was getting funded would not happen anymore. There will be a lot more selectiveness, but good companies which have strong fundamentals, unit economics, will continue to get funding. From our perspective, we can see how companies who are in similar bracket as ours are still continue to get good offers in these times, which implies that there is still enough money available in the ecosystem, just that investors have become more risk averse right now.
All right. Well, I'll just add a few things. I think right now what we are seeing from the smartest investors is I wouldn't call it value hunting, but they're going after the best companies and saying, can I get the best companies at even 10, 15% less, right? Because usually the best company will never take money unless it is at a super premium valuation. But today everyone's a little bit circumspect, wants to add more money to the balance sheet. So I'm seeing a lot of investors go back to companies that they think that they've missed and offering a price that they think that they can get into. So I think that's what's happening with the smartest investors right now. Second, I think there is going to be a phase where there's going to be a set of companies which is going to need to raise money. As far as I can see, this time around, the companies that need to raise money is going to be a very small number. Within that, depending on how you've navigated this particular situation, as well as your existing business strength, I think it's going to depend on whether those companies will raise money or not. On the fintech ecosystem as a whole, I was talking to a few global investors who have a lot of money in global fintech, and for them, they're actually looking at India as one of the biggest positive spots in global fintech, and especially for new companies, I think that's a great thing. And the net of it is that they're seeing this tremendous burst of usage going across the board. A regulator who's actually reasonably consistent. There is across all financial products, it is still very underpenetrated in terms of product penetration. So if I take the 5-10 year view, I think the world is actually very long on India and India FinTech. And so I think that's a good thing, and it's up to all of us as some of our largest companies show reasonable outcomes and are able to show growth coming out of this, I think that interest is going to come back very quickly. Last question before we sign off and maybe take one or two audience questions. If you guys had to dream and say vision 2030 for India FinTech, what does that overall ecosystem look like? And maybe in terms of just what you would like to see aspiring in terms of IPOs, market share of FinTech versus financial services. However you think about it.
Yeah. No, I mean, right. I mean, 2030. I think firstly, I think what's important is more money in the hands of people, right? Uh, like, I think one of the challenges that we've faced in this business has been people don't have money. So if they don't have money, how are they gonna save, invest, or whatever, right? Uh, so I think for me, I think the bigger challenge is, with all of this Corona added to, employment problems in this country is how does a government create new jobs, and how do we have enough people with money on them, uh, you know, to be able to consume all the fintech products. So I'm hoping that our government does some kind of magic, and finds a way to put money in the hands of as many people as possible. So companies like us, building fintech products can do well. Uh, don't really have a vision in terms of value and etc. But yeah, just hoping that the country is doing much better than what they're doing today.
Yeah. I think it's really hard to put a vision 2030 in these times. I think last decade a lot of people talked about vision 2030.
I thought both of you would state clearly that both of you have gone IPO by then.
Oh, like that.
Hopefully, I think a lot of people had a vision 2020 in the last decade, and we can look at how nobody's vision 2020 predicted that. So, but to put my stab on the fintech ecosystem, I think fintech ecosystem will definitely become a lot more mainstream than it is today. And we have seen early indicators of that. Companies like Nubank in South America, and Robinhood in US, and of course Zerodha in India have shown how fintech can become mainstream, not in just their vertical, but be the largest player in that vertical. I think we'll see a lot of such things happen in the course of next 10 years, where fintech will not be considered, okay, they operate on the fringes of the market, but they actually make markets and define certain verticals. And I personally believe that company like Zerodha will have a lot more equivalents of those coming out, and some of those will scale up to become the largest companies in the markets in the next 10 years.
So I'm going to say 2 or 3 things. One, I don't think there's going to be any difference between Fin and FinTech. And I think it's just going to be one overall ecosystem. And some will be tech first, some will be Fin first, but everybody's sort of going to end up meeting in the middle. The second, I do think some of the new players, and depending on markets, and you guys are already north of the 20-30% market share in some of the markets that you're in. So that gives you a sense of how large a new player can become in specific markets. And I think that trend is just there to continue, because there is sort of incremental spend and incremental users and customers coming to the market. And as long as fintechs, in a sense, are getting higher share of those, I think that trend will continue, and that will compound over the next 10 years. And at least that's my hope and vision. I think the last thing that I would say is that I think there is going to be a moment of reckoning for the fintechs, where all of us are going to have to grow up and really look at our compliance and risk systems. And unless we are able to do that, I don't think we can make this transition to be mainstream at all. And I know both of you deal with a lot of that ever since you guys have become large and started wearing shirts and suits. So maybe you want to just touch upon that, but I do think that's going to be one of the biggest transitions that, as an ecosystem, we're going to have to make if, we have to be accepted as mainstream financial services.
No, I completely agree. I think it won't be a choice. If you have to become large, you'll have to do that. Otherwise, it's be extremely impossible to absorb shocks like these. And as you said, like financial ecosystem in India will constantly see a lot of shocks. It has historically has. Companies who have the best governance principles and everything else will be able to beat through all of these.
Yeah, I mean, one of the things that people don't know about Zerodha is that how much importance we give to compliance. right? So because you can't be in a regulated space and take easy on compliance, so and I think one of those things that a lot of tech first fintech kind of miss out on is especially when it comes to where someone like us where we're dealing with the customers directly, uh, compliance becomes even more important than otherwise. So yeah, so I think all the tech companies need to make sure they're compliant, they're not doing anything, like this whole, the struggle I think for a lot of startup is innovation has to stay ahead of regulation and all of that, right? And people give that gyan, but I don't know if you can take those chances in financial services businesses, because some of these things can come back and bite you quite hard.
Yeah.
I don't have that much to add. Anubhav, do you want to call on anybody specific in the audience? I've tried to track as many of those questions as possible and answer some of those questions. But maybe I know we are also running short of time with everyone.
No, I think we're broadly taking questions from the Q&A tab itself. So if there's any particular topic you feel missed out, we can take that. Or probably we have covered, I think, many good topics in this session overall.
Yeah, just a quick time check. I think we're about out of time, right?
True.
You can take
yeah, that's true. Maybe 5 minutes at max.
Okay, and I know we structured this conversation a lot on sort of the future and what sort of the future holds and a long-term future holds. And when you think of just the next 3 months, and I'm sure you guys have done very detailed scenario planning on if this happens, then this is how we will react. When this happens, this will we react, and at least in your heads and so on. Take people through just how you've thought about some of those scenario plans. How detailed are those? How have you structured your organizations? So I do want to bring people back down just to the next 3 months and the short term. And we have a lot of work ahead of us. Would love to figure out how you guys are thinking about that.
Yeah, I mean, see, for us, it's about surviving the volatility, right? Because risk management becomes extremely tough in times like these, right? I mean, if you saw what happened to crude oil on Monday, right? Something going to minus $37. I mean, there is no way to manage risks when something is moving like that. So it's about ensuring that no individual position is bringing too much risk on the table. So for us right now, it's all about risk management. I'm not even thinking about are we making money, are we losing money, the focus is completely on risk management and surviving this volatility. Because because a lot of brokers, if you actually look around the world, a lot of brokers, like I think Interactive Brokers lost almost $100 million on Monday, right? So yeah, so I mean, you can't be complacent right now on that. So right now we're just looking at that, and on the other side, like I said, right, on the business side, we're trying to improve on all of these inefficient processes, which we had never thought about when things were going well. So, for example, like something like onboarding, right? As in, like a small little thing. So normally, during our onboarding, someone used to crop signature manually. I mean, could have been cropped automatically, right? Now, uh, yeah. So, for example, we fixed it. It suddenly saves a lot of time and effort. It was not so sexy, to be tackled before, but now we're trying to save time and effort wherever possible. So, on one side we're doing that, but as a business for us, especially, it's about risk management right now because volatility is more, so automatically trading volumes are more, so it generates a lot more revenue. So revenue is not really of concern. It's about making sure we don't, somehow lose money and all this.
Nithin, I know you're always very close to your consumers. What are the things that you're most worried about from your existing large base of consumers as well as sort of new base of consumers coming in?
I mean, new base, actually, I'm not really worried because, the behavior that we are seeing in new base is, it's not like they're coming and, putting all their investment. They're all taking small, little bits of the market, people investing 1,000, 5,000 rupees and things like that. I think with the whole bunch of customers, the problem is, the market's fallen quite sharp, right? And one of the problems of the market is, this whole disposition effect, which is you like to keep on to your losers and sell the winners, right? And this is a very retail kind of a problem. If you're making loss in one, profit in one, you sell your profitable stock and you hold on to the loss. And that's probably the worst strategy when it comes to investing in the market. And so even when there's a U-turn recovery, the ones that didn't do well, they'll probably continue to not do well. This is, right now we are thinking how to, kind of nudge people to do the right things. That's like the next big project we have taken up.
Harshil, next 3 months, and I know you would have, you're hiding the whiteboard of scenario plans behind you, so give us a glimpse into it.
Yeah, no, I think couple of things. First, talking from an internal perspective, we drove a general message of austerity. Right now is the time to reduce spends, control your burn as much as possible, and basically try to see if you have. I think internally we have taken a target of having. We are one of the efficient companies in our space, so we have at least 22 to 24 months of runway. And what we have done is basically created 3 scenarios. Like one is the optimistic one is a pessimistic one, and one is somewhere in between. Where we have assumed that, okay, the optimistic one, things recover in next 6 to 12 months, and the pessimistic one, it recovers longer than that, somewhere between 16ish months, and somewhere which is a balanced one. And try to see what steps we'll take as we move from one scenario to another. So right now we are trying to operate in a balanced situation where we assume that things are balanced somewhere in between there. And our teams are setting every month to see, are the numbers moving in the direction of pessimistic scenario or in the optimistic scenario, and based on that we unlock different action items. I think that's an approach that we are taking, because it's difficult to form any long-term plans at this time. I mean, it's just meaningless to set, okay, this will be our March 2021 target. It wouldn't make any sense, because nobody knows how the next 3 months will move around, how the next 6 months will move around. So I think a month-on-month approach where you can have, okay, a broad idea of where the March 2021 plan could be, but it has to be fluid. And that's why a month-on-month or a quarter-on-quarter approach will make a lot of sense. This is from an internal perspective. From an external perspective, we are trying to see a couple of things. One is, this is probably a right time to tighten up all the screws and bolts which gets missed out in growth, as Nithin said. A lot of things in weaknesses in product, in support, in tech, and all of those things get pushed down under the carpet when things are growing. Like, you just focus on growth and things keep growing. Right now, it's probably the right time to take that dust out of the carpet and clean it up. And that's what we are trying to do. So finding inefficiencies and debts that we have accumulated as an organization, and trying to see how can we use some of the free time that some folks might have to fix those issues. The second thing is, how can we then, so third thing is finally, how do we make use of this opportunity in some ways? So there are certain segments which are growing really well. There are certain new opportunities that are emerging. For example, we are seeing a drastic shift from offline to offline and offline to online, and some of those trends are expected to stick. So how can we create products and solutions to make best use of those opportunities? I think that's the third approach. So I think first is, of course, survival. Second is maintenance, which is improving the current status of the organization in these times. And third is finding opportunities of growth in these times.
Excellent. That's great. I think I'll just add, the way we've been looking at life across companies is to play defense first, and then offense. And defense has cost, runway, risk, and I think all of those need to be monitored depending on the state of the company on a weekly basis or monthly basis and quarterly, and it really is week by week, month by month across the defense element. And I think then on the offense element is the two things that both of you guys touched about. One is to make sure that all the overall debt that you have in your organization, whether it is onboarding process or whether it is technical debt, how do you actually make sure that you're fixing all of that in this period of time, because you're not going to get like a lull period to fix some of those issues. And the second is to figure out new opportunity sets, whether it is fixed income, whether it is pivoting to some of the new sectors that you talked about. So those are some of the learnings across the portfolio. I want to thank both of you guys for the time. I think we're going to continue to try and bring founders and investors together to try to share learnings. So thank you for doing this with us.